Welcome. Welcome, everyone. It's Angelo Robles. Today, what if he's right? 90 minutes with a man who refuses to blink. It's a return of the one and only, over 50 years doing what he's doing, David Hunter, Chief Strategist, Contrarian, Macro Advisors. David, with little ado, welcome back to the show.
Thanks, Angela. Well, good to see you again.
Yeah, they say the trends in podcasting is to try to get to the first question in actually 45 seconds. I fell slightly short, but for an audience that's used to me giving 2 or 3 minute opens, this is a big head start on what's going to be more advantageous moving forward. Let's get right to it. It's
Sure.
August 5th of the year, if I have this correct, that you named. Last week, chips lost trillions of dollars in days, then ripped back in the biggest semiconductor rally probably since 1999. And now, peace headlines are pouring, gasoline all over it. Is this the final leg igniting right now on our screens, what you've been talking about?
I think it is. It doesn't mean it goes straight up here. It gapped up a couple days ago, so I can't say whether we go back and fill that or not. So I don't want people thinking, "Oh my God, I got to jump on. It's running away." But I do think we are in that last run to the top. We've been in a melt up, but I think that melt up's about to get steeper and what I call parabolic into the top.
Excellent. And again, we're very fortunate about once a year to have David on. I think there is some values going back and listening to the last one I did in September of the prior year and the one prior. I would love to ask David 300 questions and be 4 hours. So I am going to have to be a little tactful in terms of what we dive into. And it's going to be a little bit of everything, including Leopold Aschenbrenner from Situational Awareness. So this will be a lot of fun. So you're calling, let me call it a top. Describe it. And what does the last week of a 44-year bull market look like on tape? I mean, are we in that right now?
I don't think so at all. I will never claim to be able to tell you what week it ends, or even when you're in it, that's the week it ends. I'll probably not be able to tell you to the month or even a couple months. But my take right now is that we are in a 44, the 44th anniversary of the 1982 bottom. So we started, in my opinion, a secular bull market back in August of 1982. It was driven, we were coming out of a major recession and the whole, Volcker era where rates were driven up and money supply was driven down to try to control inflation. It was high double digit. We turned the corner in August of 1982 and began this bull market. The Dow back then was 780. We're 50, almost 55,000 today. So that's how far we've come in 44 years. And I believe we are in the last stage. That could last 2 months. That could last 4 or 5 months. But that's how close I think we are. Not a week, not 2 weeks. I raised my targets, and I've raised them several times, certainly since October 2022 when we started this cyclical bull after the bear in 22. I raised my target several times in that time. I'm now at 10,000 on the S&P. So I think we're going from wherever we are now, 7,750 or thereabouts, to 10,000 in the next several months. Could be, like I said, 2 months. It could be 4 or 5 months. Because I think it's going to be parabolic, that's why I can say we can run that far, that fast, meaning even 2 months sounds crazy to say you can go another 30%, but it's possible because that's what happens at the end of major secular bull markets is things get very steep. And investors get very ebullient and start chasing things in a way where they're afraid they're going to miss everything if they don't jump on today. We're not there yet. There's been a wall of worry that's kept this thing from getting so overbought or getting to a top and rolling over. if you just looking back, just using 2022, you could go back to the pandemic low of 2020 when the S&P bottomed out around 2,200. But just using October 2022, we came out of that at 3,500 or thereabouts on the S&P, and really all you heard for the next several months was this is a bear market rally. It might go to 4,000. Initially it was going to only go a few hundred points. Then it might go to 4,100. Then it might go to 4,500. Then it might go back to the old high of 4,800. But all of that time, institutional investors thought this was a bear market rally and was going to roll over and go to new lows, below 3,500, maybe below 3,000. It's only been in the last, I don't know, probably when we got up over 7,000, where the institutions started saying, hey, actually they started saying we're in a bull market when we went to new highs above 4,800, but they never thought it could go more than a few hundred points higher, and they've raised along the way. You're now seeing all of a sudden numbers like 8,000 out there. You didn't see that for the last year or more. And I've been at 9,000 and above for well over a year. So what I think you're seeing is the beginning of that wall of worry being, brought down a little bit, or the skepticism starting to disappear. And what you're going to see in the next few months, I believe, is a full-blown shift from skepticism, one leg out the door, one foot out the door, to all in. This thing has legs and can go for a couple of years or more. And you're beginning to see even some of that rhetoric come out now.
David, your melt up, I would state, needed falling inflation and rates at the same time. Inflation stuck above 4%, and the Fed's leaning towards hikes. What fuels a parabola into tightening?
Well, I take issue with 4%. It's 4% on a very short-term basis, but the trend is still down. We came down from 9% in the last couple of years of the Biden administration. We came down to 2.5%. The war in Iran has pushed oil prices obviously up, and some other things, fertilizer prices and some other things. And so you did have a bump up to something like 3.5%, maybe not quite 4%. But if you look at some of the other indicators, other measures of inflation, like truflation, they've been down under 2% for this time, and they may be more accurate than the CPI or the PPI or the PCE index, even though the Fed looks at PCE more than any of them. So I would argue what I've said all along, and we could talk about Warsh down the road, but I'm very gladdened by Warsh talking about the need for the Fed to look at trends, not month-to-month data. Trends are what matter, and the trend in inflation, in my opinion, is still down. Yes, we've had a counter-trend rally in inflation, if you will, but most of that is driven by Iran, by what's going on in Iran, and mostly by oil prices and gasoline prices. So as that evolves, if we really are going to see the strait open up here, you're going to see oil back into the 60s pretty quickly, and maybe below that. And that will go a long way to bringing inflation back into the 2s. And ultimately, I'm calling for a global bust, as you know. In that global bust, I think we'll be looking at deflation. I think it's next year, we'll see. So I'm in a very contrary place, as I often am, in not worrying about inflation. I'm much more worried about deflation in the year or two ahead.
Do you feel that AI, theoretically technology, especially something that, let's go with once in a lifetime, that's only about 4 years old and advancing very quickly, that could lead to significant deflation?
Yeah, the deflation I'm mostly talking about is macro, as I say, macro driven. As I say, if you enter a recession that morphs into a bust, with inflation below 2%, which is where I think it will be when we enter that place, you're going to quickly go into deflation. And because a bust, just to simplify it, I can get more complicated in terms of what a bust is, but I'm calling for something worse than 2008-9, and in both financial crisis wise and economically certainly is bad. So if you go into that kind of a period for a year or more, you're looking at, and if you're going into it with inflation almost, below 2%, it's a given it's going into negative territory. You can add on to that the longer term consequences of AI, which will enhance productivity and will help control inflation. I do believe with my whole scenario about how, what happens in a bust and what happens to central banks, how they respond to a bust, how the Treasury responds to a bust. When you go through that scenario, I do believe it will turn into a hyperinflationary environment on the other side of the bust. And so, yeah, AI will help ameliorate that to some degree, but boy, macro will trump all of that, in my opinion. No pun intended.
Oh, we have much to, well, overused term, but unpack there. Uh, every sell off since, let's say, COVID 2020, you called a fake out. And last week, the tape proved you right again, like in 5 trading days. But here's the harder question: when recoveries get this violent, this fast, isn't that itself like the top signal?
Yeah, I part of my scenario that I've stated consistently through the last 6 or 7 years is that if in fact we are in the later stages of a secular bull market that's been going on for decades, that what we would see, and I said this, way back probably 2019 and 2020, certainly since then, um, I have stated that if you look at the legs to this bull as it moves along here, that the legs would get steeper and steeper. And that's what we're seeing. If you go back, just look at since 2022, each of the successive legs, and then I don't think I called the corrections fake outs. I called, I'd say investors got faked out, for instance, in silver when they went for the, or they got bearish at the bottom. I called those fake outs. But the actual corrections, I think, are a normal part of the process. They're consolidations that build the wall of worry back up and allow you to have fuel for the next advance. But my whole scenario has been that we would steepen into the top, that each leg would get steeper. And if you just look, like I said, just look at the last 4 years, you would see that each of the successive legs, 2022 to October 23, October 23 to October 24, October 24 to the April swoon on the announcement of tariffs, the big rise out of that April swoon into the October, I think it was October 25 top, and then we've had since that we've had successive rallies that get steeper as we go. So we're at the point now where as it steepens here, it's going to be parabolic, and I would even argue that the 2-month consolidation we saw in June and July, if you look at it on a monthly basis, we may have started the parabolic, when the rally started. I guess it was the end of April. That steep rise out of the low, the war, the Iran war lows in the spring that ran to the beginning of June. We didn't really lose that parabolic or that rise in the consolidation. It was a pretty much it. You did in some things, and certainly in some of the AI stocks, but in terms of the S&P and if you look at it on a monthly basis, you could argue that you really didn't violate the beginnings of a parabolic. It's semantics. I don't really care whether this is a new leg starting in at the beginning of August, or whether this is a continuation of things that started back in April. Either way, it's going to steepen from here.
I mean, related to that in some of your prior comments, and with all due respect, David, your targets climbed the whole way up: 4,500, 6,000, 8,000, 10,000. Skeptics say that's chasing the tape. If you don't mind, maybe defend is not the right word. Explain, or if you want to use the word defend, the method.
Yeah, I'll start with prefacing John Maynard Keynes, who, when criticized for his forecasting because he changed some forecasts. Said, "Dear sir, when the facts change, I change with them. What would you do?" And I would say that's if you talk to any macro strategist, you're giving this isn't the price is right. This is not put out one number and never change it. You can't go over, like if anybody knows the game show, The Price is Right, you try to guess the product price without going over it. Well, this isn't that game. We're looking at new data every day and every month and every quarter. And so as things change, you change with them. So that's the first defense. The second defense is I've remained steadfastly bullish from basically the lows in March of 2020 until now, because people will say, "Well, you've been calling for a bust for 6 years." And I said the bust comes after the bull market is over, and I've remained steadfastly bullish from the beginning. So from 2020 or before even. So I don't know what the problem is. I mean, yes, I've changed. I've raised them as I saw. The other thing I would tell you is that if you look at when I make my changes, I get criticized for this sometimes because people don't understand it. Sentiment drives me a lot because I'm a contrarian. I'm often raising my targets when everybody else is turning much more bearish.
True.
So that I'm not raising them with the momentum. I'm raising in the opposite direction. In April of 25, when we had the big drop when Trump announced tariffs, as you remember, we had almost every strategist out there was lowering numbers and saying the bear market has begun. We're going a lot farther south. We're going to 4,000. Maybe we're going to 3,000. It was at that 4,800 or 40. I'm trying to think where we got down to, but the lows of that sell-off was when I raised my targets because sentiment had gotten so bearish at that point in time. It was clear to me we had sentiment almost similar to what we had in March of 2020 after a 2-week sell-off. So that's how my work is. A lot of it's driven by sentiment. Obviously, I look at fundamentals, I look at technicals, I look at macro, but sentiment is a very important piece of it. So, along the way, I've been surprised. Obviously, I started with targets. I probably started with a target of 4,000 going into 2020. In March of 2020, I might have had a 4,200 target. I've raised it, many times since then, 4,500, 4,800, 5,300. Those are the early ones. And then 7,000, 7,500, 8,000, 9,000, and now 10,000. And I've raised them in big leaps because my work just kept pointing to this thing has legs. And I was all the way through well above any other estimate on the street. I mean, even today, I think the highs on the street might be 8,200, and that's a very late. That's what we're getting today, I think, somewhere around 8,200 as high numbers, and I'm at 10. When I was at 9, there was nobody much above 7,600. So, I don't do it to be provocative. I don't do it to, get attention or to be different. I am doing it simply because that's what my analysis points to.
Remind me if I'm correct about a little bit of the multi-step process here from our last maybe 1 or 2 conversations. Are we in a melt up? It's going to result in a crash, perhaps in the next year. Then we're going to have a little bit of a euphoria where things may be great and really rise up, sadly, to come within maybe 10 years to a crashing end. One, do I have that right? And even if I had it right a year ago, what have you adapted? And I'm making it a little too complicated now, but is AI going to change some of that 1, 2, 3, 4 assumptions that I noted?
Yeah, I don't think so. My assumptions are still pretty much the same as when we talked last time, a year ago, if it was. Um, I do believe that, as I said, we're going into a secular top here, 44-year secular top. Um, and after that top, and by the way, when I talk about a global bust, it refers to the economy and the financial system. And the reason I call it a bust is because it'll be accompanied by, I think, some big bank failures, some major financial crisis, similar to what we saw in 2008, but maybe worse. So people hear bust and they think I'm referring to the stock market. No, bust refers to the economy. Bear market is what will accompany it that refers to the stock market. So I believe the bust and bear market will follow this last run up. Like I said, I think it's next year, but I certainly have had to push this out year by year by year because I thought it happened sooner than this. So, guilty as charged in terms of that. But I'm lost my train of thought in
Well,
terms of.
whether it's the right move or not, the bust, as you describe it, potentially banks and let's go with corporations important to our ecosystem. Let's say it is a bank. Let's say it's, I'm throwing it out there. We have two massive private companies in AI that are among the largest companies on earth, OpenAI and Anthropic. I don't see, whether I like it or not, I don't see the US government allowing companies like that to fail. AKA, they're too big, or maybe their perception too important to fail.
Yeah, my whole thesis for a global bust is predicated on the fact that we have leverage in the system, and I'm talking about a global bust, so this is worldwide. Leverage in the system that it blows away what we had going into 2008, 2009. We are so far more leveraged as a world economy and a world financial system than we were back then. We've never been, and that was way off the charts. So we've never been here before. And leverage works great on the way up. It enhances. But as we just saw with our hedge fund friend,
Aschenbrenner, yes.
yeah, it goes the other way, just maybe even faster. So that is kind of a microcosm of what I think we'll see in the world economy, the world financial system, in terms of a pretty simple thesis that once the economy heads south, that leverage is just going to take it far beyond what we would normally expect. And it's not a bank or one place. There'll be a lot of places where the leverage will show up as a problem. We just saw the hedge fund situation, but it's pension funds that are loaded up with private equity and private credit. It's banks overseas. I mean, China. I just saw a video on my feed today. Somebody put up that was about a big project in Malaysia, and these two guys, took it upon themselves to go discover what this place was, and found it was empty. It was multi-billion-dollar project, and there was nobody living there. It was high rises. They had a big mall to go with it that was marketed as this great shopping center, and it was all they had pictures on the glass, on the storefronts, and no storefronts were active. They went into the only restaurant that was available in the whole so-called new city, and they went in and sat down, and there were like 8 other people in there. As soon as they sat down, those 8 people got up and walked over to their table. They were all part of the staff. There was nobody there. So, but it turned out it was a China project. And then China pulled the plug because of all the problems in real estate in China and stopped allowing. It was meant to be for their people to invest in Malaysia in a project. And they pulled the plug on it and don't allow them to invest it. So it's sitting there 2 years empty, multi-billion dollars, and you can probably multiply that by many other projects. So the point is, it's not just the U.S., it's not just Europe, it's not just Japan, it's not just China. It's worldwide. We have this way over leveraged system, and maybe I'm premature, and it's going to be able to be pushed out some, but I think it's coming this cycle. Whatever Whether it's months away or a year away, I don't know. I keep saying I think it could happen pretty fast.
David, a little tricky one here. Steelman, the Bulls, real earnings, real productivity, better margins than 99. Make the case this is maybe like 95, then of course I'll let you kill it.
Yeah, I mean, earnings have been through the roof. When you look at what the AI earnings are, amazingly. But what we're hearing now is that for this quarter, you're starting to see the laggards, the kind of more conservative companies are starting to see their earnings turn up in a nice way, so that you take out AI, because everybody thought, this is just AI or this is just semis. You take that out, and you're still getting something like 13% earnings growth out of the so-called boring stuff. So we are in an earnings cycle that's unbelievable. Some of that may be AI already, but a lot of it is just good old-fashioned cost cutting, hunkering down, and being able to have healthy profit margins in spite of oil, in spite of all the doom and gloomers out there talking about how this was all going to be a train wreck. So that part is there. In terms of being 95, this is far too frothy. I remember 95 because I had made the case in the early 90s, like 93, 90, 92, I guess I was at an insurance company running their active equity department. And I, again, in my contrary way, there was a chart circulating back then that showed the relationship between consumer stocks and capital goods stocks. And of course, capital goods includes technology. And it was at all-time lows. Capital goods, consumer stocks had gone through the roof. They've been, they were in their last parabolic stage from a move that started in 1982, because in 1982 inflation peaked, and that was the beginning of buy the steady growers, buy the kind of the steady growth stocks, and get out of inflation hedge stocks. And I made a lot of money by understanding that that's the time you make the switch, is when inflation's at its peak, you buy the stuff that's anti-inflation. So in 1982, I made that call. In 1992, I made the call, just the opposite one, saying these growth stocks are way overvalued. They're at their cycle peak, secular peak, if you will. And it's time to load up on capital goods. So my portfolio at the insurance company was very concentrated in some old industrial capital goods, the Caterpillars of the world, the Deeres of the world, but also a big chunk of semiconductor and semiconductor equipment companies, and a couple other tech companies. So that over 50% of my portfolio was tech at a time when nobody wanted tech. You could buy Texas Instruments, which was in my portfolio at that time in 92. You could buy it basically because a lot of their contracts were government. When you backed out the government funding and stuff, you were buying it at book value.
Wow.
And you were buying things like Teradyne. I had Teradyne and KLI and KLA, and you're buying these things flat on their backs in the next 3 or 4 years into that mid 90s, 95, 96. They started slow. I was in there a bit early, and the consumers had one last hurrah, so I was underperforming. But then when they started, they took off, and by 95, they were already moving up pretty nicely. The portfolio I had outperformed the S&P in the 90, I think it was the 93, mid 93 to mid 95 period by 5,000 basis points, 50%.
Oh my God.
The S&P in that time was flat or not very far, and these stocks were up 50%. So, and that was the whole portfolio. So it wasn't just the semis. So I would, and then from there, the rest is history, because the real move came in the late 90s, as you know. I mean, the whole .com story. So 95 was very early in that. We're not anything like that today. I think the conditions today are much more like 99, if not 2000. So, um, I think 95 was a very early time in tech land. Now we're probably later. Now, that being said, I'm looking at it cyclically, not secularly. There is obviously AI is probably going to have a shakeout in the bust, but that doesn't mean it's over. There's probably a long, AI investment cycle and AI cycle, beyond the bust. But it's not going to be a straight line. There's going to be probably in the next year a shakeout.
And David, not to give away your secret sauce, some shorts, a complexity of various things that you look at, but for my family offices listening in, I don't know, people seem to like things in threes. Maybe what are three indicators, employment rates, whatever it may be, that you look at that you think are important that form a lot of your views?
Yeah, as I said, sentiment is huge for me. So I don't have any favorite sentiment indicator, but I look at, several, and you can get a pretty good sense, even on my feed, of where people are sentiment wise. Because I mean, just a week ago, I was an idiot. And now, I'm getting people saying, "Well, you're right. Wow, you're so right." But a week, I had somebody private message me and say he was writing some kind of a letter, investment letter or something, and I was going to be the feature of it as a fraud. You know, he just thought my whole viewpoint is stupid and fraudulent. So it's just amazing. That's the sentiment that was out there just a few days ago, and now all of a sudden you're getting people jumping on the bandwagon. So it's changing fast. Sentiment is a big one. I'll rather than, because I'm not really into. I look at trends, so it's not so much what's the data point that's going to turn this or anything like that. The trends are healthy, industrials look good, all of that. As I say to people in more generalities, my analysis includes technical analysis, um, fundamental analysis, macro analysis, sentiment, and cross market analysis. By that, I mean, I look at, you know, for instance, months ago, I saw the coming financial move where the financial stocks were starting to technically look very good, and materials now also, um, and copper and things like that. So it was very hard for me to get caught up in, because I'm talking about a recession coming. I go, but I see too many good things out there telling me it's not yet. That may come in, faster than we realize, but right now what I'm seeing is a broadening market. And I'm saying right now, 3 months ago, when everybody was talking about too narrow a market and worrying about Iran, et cetera, I was looking at a market that had, a lot of laggards that were starting to pick up speed and starting to look like they had long runs ahead of them. It was hard for me to even begin to get bearish when I've got that kind of stuff to look at. So that's how that's how my work kind of works. It's less about quantitative, let's sit down and compare, PEs or that kind of stuff. I was a value manager prior to being a strategist, so I look at PE multiples, I look at all of that stuff, but basically it's more the top down big stuff.
Okay, we promised we would come to the 25-year-old Leopold Aschenbrenner, situational awareness. Woo, 45 billion at 400% leverage, up 439% until a point last week that it wasn't. Lost 67% in a single month. Sold, I guess, the public book to Citadel at obviously a discount the week of his wedding. Is this the long-term capital management, the LTCM of this AI era?
I don't know if it's that. It certainly marked the bottom for this cycle, I believe, anyway, for this correction, this consolidation, and it gave you. I think part of the reason we're seeing the reversal here is it really put an exclamation point on what really was behind the sell-off in semis, what was behind the sell-off in the Mag 7, and what was a sell-off in AI in general. Once it became clear it was this one guy, and that he had just taken a way too big a bite with leverage, and then found out that he had basically unwound it all and was out of it completely. I think it cleared the air so much for those that were fearful, worried that we were at a top. Once they saw that that was what happened, and saw that the market held in spite of that, it really gave, I think, kind of a vote of confidence to the market for a lot of people who weren't so sure. And that's why I think we're just starting this next run, and it's going to build pretty fast, because I don't think it's just overcoming a couple months of anxiety. I think it's also overcoming basically 3.5 years, going back to October, almost 4 years now, going back to October 2022. You're at that point now where I think a lot of those that have had one foot out the door have brought that foot back in, and at least are beginning to bring that foot back in, and you're about to see, I think, of a united bullish front here, which we haven't had for all that time. We've climbed a wall of worry. Now, ultimately, it'll be troublesome because that wall of worry is going to go away. But I think as I tell people, I'm a contrarian, but I recognize very well from 53 years of doing this, there are times, big, lengthy periods of time, when the consensus is right. And we're about to see the consensus jump on this bandwagon and be bullish. So I think it's, I get accused of sounding too consensus when I'm a contrarian, and I go, yeah, that's because the consensus is about to be right.
Staying on Aschenbrenner a little bit, Kramer says that forced selling is a clearing event, I believe is what he said, a bottom. Clearing event or first domino, but it probably can't be both.
No, I think it's kind of are you talking about longer or shorter term, right? And I think in this case, for this period of time, it is definitely a clearing event. I mean, you saw it in the move we've had the last few days. You see it in the charts. You see it in how, what got taken to the cleaners. It was a clearing event. He's absolutely right about that. From a long-term standpoint, did it clear the leverage? And not, it's the tip of the iceberg in terms of the overall leverage in the system. But, this was a case of a 24-year-old guy who had a lot of success playing momentum, but didn't have the years of experience or hadn't been through a cycle to understand how that leverage can really take you down as well as build you up. And he just it'll probably help him going forward to be a better investor, because he just got his head handed to him. Fortunately, he made a lot of money and still has a pretty good chunk. But boy, he lost a lot of money from inexperience, is what I'd say. And
Sure.
it's amazing. Markets are a humbling thing. There's not a successful investor that I know of in the history of this business who hasn't been humbled by the market. It's part of the learning experience that makes you a better investor. As I say, what separates good investors from bad is that the good investors learn from their mistakes. The bad investors just keep repeating them every cycle.
His thesis was arguably correct, and the fund, still died is too strong of a word. He has some great private holdings and still has billions, but let's go with it. What's the lesson? That's the more important part of this. What's the lesson for every family office holding levered AI exposure today?
Yeah, well, the cows are out of the barn, at least in the short run. I wouldn't learn from that lesson too quickly, but it is a longer term lesson that I'm sure many of the family offices and certainly hedge funds know, is that leverage works both ways, and it certainly can punish you pretty badly on the way down. And so I think that's the key lesson. It just I talk to retail a lot. I mean, I retired in 2013 and joined X soon after that because I said this is a hobby for me as much as it is a vocation. It's an avocation. So I decided I could help the retail public by being on there and kind of teaching a more contrarian message about trying to get them to learn not to pay as much attention to the short-term noise and the CNBC crowd and et cetera, and understand markets a little better than that and not get caught up in the tape, as I call it. Um, and so, something like this is kind of what I've been preaching. I said to a lot of people because I get blamed for people's losses. They'll go, "Well, you were bullish." So I said, these are cycle forecasts. I'm not a trader. I'm not telling you what's going to happen in the next 3 months. These are cycle forecasts. And but what I would tell people is if you're playing options or you're very margined, you're going to have periods where the market goes against you and you may be taken out of the game. Whereas if you are an investor, what I'm forecasting, you should be fine. You just ride through those consolidations. But what I see a lot is, it's the whole greed and fear thing. This guy just got a little too greedy.
Maybe last question on Aschenbrenner. The Collisons, those are the founders of the giant private company Stripe, Nat Friedman, Jane Street Money, billions wired to a kid, I guess to me, a kid who's never traded. Very smart. I wish him the best. And I think he will be a figurehead moving forward, but never traded. Why does mania, again, the more important part of my question, why does mania make smart money sometimes the dumbest in the room?
Yeah, it's amazing. Again, you're talking to somebody who put so much, I spent my whole career looking at sentiment. And I can tell you, behavioral economics, how investors behave is probably 75% of the game. I mean, it's just amazing. You can talk to the biggest institutions out there, or all the talking heads that want to come on CNBC and give their opinions. For the most part, the majority of them will have rationales for their opinions, right? For their forecasts. By and large, if you really track it, and I have for many years, not scientifically anyway, but just watching it, they're being driven by the tape. Just like they were negative a week ago or 2 weeks ago, those same people now are jumping on the bandwagon and giving you a rationale why things have changed and why they're bullish. What changed? What changed was the tape. And I use the term tape for the market. And so it's the same thing, I'm sure, with prime brokers. The success that he had drove more belief. Early on, they probably said, "Oh, this guy's wet behind the ears." We got to be careful with him. But as he started becoming probably the most successful hedge fund manager out there, they started believing because he was showing results that were through the roof. And so you start little by little getting drawn into that. And by the end, you're a full believer. This he can walk on water. He knows what he's doing. They didn't stop and realize what he was doing was playing tremendous momentum, and that momentum reverses just as fast as it goes up, maybe faster.
For sure. Let's switch over. We've hinted at it to Warsh. So Warsh held at 3.6%, 9-3 dissents demanding a hike. And he says he has no tolerance for inflation. Does he hike in September? And what does that do to your parabola?
Yeah, so I don't try to predict month to month or meeting to meeting. I feel it's kind of a fool's game. I'm as I said before, I'm somebody who follows trends. and I've spent many, many years on X preaching that the bond market sets rates, not the Fed. That this silliness of watching the Fed and agonizing over what the Fed's going to do, looking at dot plots, listening, looking at what traders have priced in for cuts or hikes. None of that interests me. I think it's a giant waste of time. So it's been music to my ears that Warsh is trying to get away from that. Keep in mind, I cut my teeth. I had Arthur Burns as a Fed chairman when I first started. Then I had G. William Miller, who was a disaster in the late 70s under Carter. Then Volcker. And Volcker came in and basically said, the problem is we've been targeting rates now. And I lived this. I watched it, and I was monetarist, so I knew he was doing it wrong. But Carter made the mistake. I mean, not Carter. G. William Miller made the mistake because rates were rising in an inflationary environment. He had hiked rates. He made the mistake of thinking he was tightening, but rates should have been going up a lot faster than he was actually printing money, so they wouldn't go up faster. He wanted to bring them up gradually. So money was going in the system at a rapid rate and pouring fuel on the fire of inflation. And that's why we got that. We went from, 5-6% inflation, all of a sudden we're at 7, 8, 9, 10, double digits. Volcker came in and said, I'm no longer targeting rates. I'm targeting money. We're gonna crank down the money supply, M1, and let rates go wherever they go. Because when you crank down the money, you're not printing money. You're not able to control rates. The bond market's going to take rates, and that's when bond vigilante became a new term. But frankly, that's what Warsh is coming in now saying is basically, I'm not here to target rates. I'm not here to think I know best what the right Fed fund rate is at any given point in time. We're going to let the bond market kind of tell us some of that. Now, the bond market spoke loudly the day after his meeting, but I think that was more of a tantrum than it was any kind of indication of where rates are going. Bond market doesn't like to be told what to do or doesn't like change. We've had this system under probably a little bit under Greenspan, but certainly under under Greenspan, I guess, and under Bernanke, and very much so under Yellen and Powell, where it was, we spent all our time agonizing over what's the Fed going to do at this meeting? What's the Fed going to do at the next meeting? How many rate hikes are there? We're still doing that, right? Warsh doesn't want us doing that anymore. He wants you to, look at the data, look at analysis, do the analysis, and make your judgments not on us. We're, that's why I forgot the term he used, but they're the referee, I guess is what he said. Don't look to us to determine where rates are going. Do your economic analysis, do your financial analysis, and look at where things are going. And that's why I believe what we're going to see. You've heard me say at the outset of this meeting, this interview, I believe we're going to see inflation trend down and rates trend down with it, such that you could be probably at 3%, certainly within 6 months. Could happen faster or slower, but you wouldn't get that from the dot plot. You wouldn't get that from most of the Fed rhetoric. You certainly wouldn't get it from Neil Kashkari, who I thought that was kind of an interesting one-upmanship or a little bit of a backstabbing for him to go on CNBC and talk his book about what rates are going to, what rates are doing or what we should do or how the Fed should be run. You have a new sheriff in town. Your boss is Kevin Warsh, and he's basically saying, I want my, not because he wants to control it. He just doesn't think it's good for what their job is. He doesn't want all these Fed speeches out there every other day. You look at it. in the last 2 or 3 years, there was one Fed member or another, one FOMC member or another, or one Fed bank president or another out there talking about their view on interest rates. We didn't used to get that. And actually under Greenspan, he did a lot of double speak and Greenspan speak that was confusing because he didn't want you to really know what they were thinking. He was notorious for talking a lot but saying nothing because he was trying to keep it close to the vest. And I think Warsh learned from him some of that. So they didn't like his post meeting presser, but I think it was a little bit of Greenspan. I'm not here to tip my hand on everything we're doing. He has said he's going to, he knows it's a collegial group. It's meant to be, kind of management by committee. So he's not going to be dictatorial about where things are going. And he's not a puppet of Trump. That's not what it's about either. He's really trying to get them to be more long-term focused and get away from this meeting to meeting thinking they are smart enough to tell everybody where rates should be. And he's also a supply sider where he's saying part of the conflict I think that the media has, because they've grown up on this Phillips curve idea that if the economy gets stronger, we have to tighten because that means inflation's coming. He's saying that's not true. If you have a supply side incentive to produce, to create supply, it doesn't lead to inflation. If you have enough capacity out there, inflation doesn't necessarily automatically have to go up when the economy is doing well. He's really, so that's why all these people wanting to know, he says he's going to get inflation down to 2%. They want it to happen in 2 or 3 months. That's not what he's talking about. He's talking about the trend towards 2% will be their mandate. That's what they want to do. But it's not about the next 2 or 3 months. It's about the next year.
Well, you answered kind of the first part of what I was going to ask, which is Warsh killed forward guidance, 2 decades of Fed handholding over. But maybe the follow-up to that, what happens to volatility when the Fed goes silent, like at the top of the bubble?
Yeah, I really don't think it matters all that much. It's, again, we're going to have that volatility no matter what. That's one of my struggles is I think Kevin Warsh is the most qualified person for the Fed chairmanship we've had maybe ever. And that says a lot because Bernanke was qualified, certainly, having done his thesis on the Great Depression, et cetera. Greenspan was a master at certain parts of the Fed job. And Volcker, of course, is up there on Mount Rushmore in terms of a Fed chairman. But I do think,
and the fact that he loves cigars makes him beloved in my mind, David.
Yeah.
Only us, probably 60 or older, will even get that reference of what Volcker used to do inside the most hallowed grounds of DC, smoking his cigars.
And he did it with his New York accent. I mean, he was a master at kind of sitting back with a cigar and pontificating, So I loved Volcker. He was great, and he did the right things back then for sure. But I do think Warsh in his training is well suited for the job, well qualified, and is a bigger thinker than what we've had of late in terms of Fed chairman. And he's going to change things over time. It's not something quick, but. I forgot the question.
Well, speaking of things, as of late, Powell is still on the board, a former chairman. Watching his successor, does it matter, or is it just theater?
I think it's mostly theater. I think Powell hopefully behaves himself there. I think he will. I understand he's there probably most definitely because of the lawsuit. He's pretty much said, I'll leave when that thing's pulled away,
Right.
But I don't, I don't know what he's doing there really, and it's kind of awkward for him to be there. But I
True.
think he's. Uh, I was a defender of Powell through much of the last few years when a lot of people wanted to attack him and say, there were things I had trouble with that he was doing, and I think he was a bit political, but more or less what I have said for the last couple of years is all the criticism he got, when you step back and look, the Fed basically managed through a difficult period, brought inflation down without crashing the economy. How can you fault that? So they were more right than most of the critics in terms of that period. That being said, I think it would do him well to just step away. It feels a little bit political, and frankly, he's got a loyal group on that committee. And I feel sorry, and not feel sorry, but I do feel like Warsh has, he's got his work cut out for him a little bit, because he's trying to change things, and you've got a Powell group in there basically more than you don't, and they're not. I think even though they're not speaking vocally about it, you can kind of read between the lines. At least some of them are not liking the fact that the game's changing. They don't like what he's. They wanna be out there speaking. They want to give their opinions, and I think you see a little bit of that in the after effects of the presser, the after effects of that meeting. Like I said, I really thought what Kashkari did was kind of a not very professional. It's like your boss is telling you he doesn't want to see this anymore. And yes, you're not on the I don't know if he is on the FOMC or not, but he's a president. And yeah, you're entitled to have your opinion and all of that. That's fine. But to come on CNBC and kind of spout off about things that are kind of contrary to what Warsh is trying to do, I didn't see the need for that.
There is a viewer in chat that does want me to go back to that prior question. It's pretty simple. What happens to volatility when the Fed goes silent at the top of the bubble?
Yeah, so here's what I've said, and I'll get around to answering that specifically, because probably my answer to that is I don't know, but what I have said is it almost, and that's where I was going before, and I lost my train of thought. I have said that whether it was Powell in that position, Warsh in that position, or anybody else, that when we go into a bust, their hand is going to be directed by the crash. By the bear market, and the bust is going to be so bad that no matter who they are and no matter what they say today, ultimately they would all be forced to do the same thing. So as much as I think there's a huge difference between Kevin Warsh's approach and Jay Powell's approach to monetary policy, in the end, that bust is going to trump all of that. And I'll explain that by saying, and I think I probably said this a year ago, I expect this global bust to be something worse than 2008-9, which means, and you're going to have a free falling financial system, not a bank or a company, but a financial system that's in free fall around the world. They are not going to be able to say, well, we don't believe we should follow the script we had in 2008-9. We think that was a mistake. We're not doing that again. They can say that on the way to that point, but once this system starts breaking, they're going to be deer in headlights and saying, well, we got to do whatever we got to do right now. We'll worry about that later. I believe, and this is just seat of the pants, but I believe we'll be looking at something like 20 trillion expansion in the balance sheet. So maybe more. So we were at 9 trillion. We were at 9 trillion in 21. Yeah, 2020, 21. We went from, I don't know, 3.7 or 4. We increased at 5 trillion. We backed it off. Now we're at about 6.7 trillion. I believe we'll be at 30 trillion in response to the bust. And that's just the Fed. Every central bank will be doing proportionally something similar. the money coming out of the system, coming into the system will be unprecedented, to say the least. We did 3.7 over the course of several years post 2008-9. I'm talking about doing 20 trillion, just the Fed, and then maybe another 30 trillion from the other central banks.
Well,
So, but before we get there, when we reach a top in the market and it starts rolling over, what's going to happen? Actually, 2008-9 is actually part of the problem, because and Warsh, maybe even more than Powell, but both of them have said they don't want to go back to that again. They don't want to go back to zero interest rate policy. They think that was a mistake, and it was. They don't want to go back to printing money like there's, QE infinity, like there's no tomorrow. So that means early on in a recession, early on in this bust, or on the way to the bust, they're going to say, yeah, we're not doing that again. We're going to go slow here. We'll cut rates a little bit. But we're not going to have the balance sheet zoom up. We're going to, maybe we need to put $1 trillion in, but we're not putting, 3, 4, or 5 trillion in. They'll look, and that won't put a dent in it. It'll keep going down. They'll come back and say, well, I guess we got to do a couple more trillion. But boy, we can't do much of this because we don't want to go back there again. And we got to remember to take this back out right away. And that won't do anything. In other words, the very fact that they don't want to repeat 2008-9's mistake, and they're cheered on by most of Wall Street, right? Most of Wall Street agrees that it shouldn't happen again. That means they're going to be slower to respond this time than they did then, or than they did in 2020 by a long shot. That means many months probably before they get to a right size policy. So in answer to that question of, and this may have been a question from way back when, earlier in our interview, but when you have, AI companies going, looking like they're going to go under, or you have a bank looking like it's going to fail, how come, we know the Fed will just step right in? No, I think the Fed's going to be slow to respond. And it's that, when you're in this point of a cycle where things are really unwinding fast because of leverage, a month or two can be an eternity. So I'm not saying they're going to be a year late, but if they're late by a few months, you could have a much deeper decline and see many more failures than you would have seen if we hadn't had 2008-9. They're fighting the last war. They don't want to go back there because they got criticized so much for all that money printing back then and zero interest rate policy. But the problem is we have far more leverage today than we had then. We're going to likely have a faster unwind this time than we had then. And it's going to require bigger and faster responses when their inclination is to be slower and not responsive. You put that together, that's a big conflict.
So, maybe I have this a little off. If your bust needs 20, 30 trillion of, my words, panic printing, Warsh built his career attacking exactly that. Why does the hard money man fold?
Because you have a choice, and that's why I say it will trump these guys. Because you have a situation where you're looking at it, and again, I'm theorizing it'll come in some different flavor than I expect probably, but they're looking at this thing, and all of a sudden things are coming apart at the seams. Again, it's not going to all of a sudden happen one day. They're building up to it. They're responding to, problems in private credit, let's say, or problems in commercial real estate, or problems here or there. They're going to see some of this coming, but then all of a sudden it reaches a point where it starts really unwinding fast, or banks are starting to, almost, if you remember October of 2008, the critical point was when the commercial paper market froze, and the rumor around the street, I can remember this the day it happened, the rumor around the street was GE credit's about to go under, and so will GE. If you remember that, the policymakers responded quickly and opened up the commercial paper market. They stepped in, They went to, I think, I may not have it exactly right, but I think that was when they went to the, we won't break a buck on the money market funds. And they stepped in all of a sudden and said, this is serious. We got to do all these things. And they held the markets together. If they hadn't done that, we would have had the bust then. The difference between then and now is this time I think we go over that cliff because these guys are fighting that 2008 story. They don't want to do that again because of what the aftermath of that was. So that makes them more reluctant. But at some point, as we go over that cliff, they well know when that point comes, they're going to understand if we don't do something today and tomorrow, we've lost the world's banking system. In other words, there's a domino effect going through the banks. And if we don't respond now, and the only way they can, the reason why I know it'll be the Fed and the central banks is fiscal policy doesn't fix something like that fast enough. The only thing that moves fast enough is to get liquidity in the system. And that's what will drive this is the need for liquidity in a big way. And like I said, it'll start out with thinking, okay, $1 trillion might do it, or 2 trillion might do it, or 3 trillion might do it. Ultimately, each of those shovelfuls is not putting a dent in it, and it continues to get worse. They come in with both feet and say, okay, we just got to do whatever it takes. And then, and because inflation lags money printing by probably 18 months, there was a technician on Wall Street by the name of Stan Burge years ago, back when I was early in my career. He was at Tucker Anthony in Providence. I was at Textron in Providence. I went to lunch with him one time, and he brought out he was an engineer by training. He went into this because this was his love, but he was a technician. He brought out all his charts to show how inflation has an 18-month lag to money supply. And so you can print all the money you want. Let's say the bust hits second half of next year in a big way. You can print all the money you want in that second half of next year. You probably won't see the real inflationary effects of that until 2029. So, it might start picking up some the next year, but so they have the benefit of you're in deflation, you're printing money, and there's no immediate inflation effect. So they're going to deal with the here and now. The emergency right now is the economy and the financial system. We'll worry about inflation later. The problem is once it does hit the system, with that lag, it's going to hit fast, and you're going to go in a matter of a few years. You're going to go from, low single digit inflation to high double digit inflation. So that by 2033, let's say, you could be looking at 25% inflation in this country.
It's well, you gave me a good clickbait there for a 30-second clip. So thank you, David, by the way. And a little scary. Someone does ask in chat, ask Dave if AI stocks are done in this rally.
Good question. I don't think so. No, some may be. I believe that I gave you my numbers before. If you do, my number for the S&P is 10,000. My number for the Dow is 70,000. My number for the NASDAQ is 36,000. If you do the math on that, I did it before the meeting today just to kind of know where we're at because we've moved so much. I think to those targets, the Dow, based on numbers this afternoon, the Dow was about 28% to that target. The S&P was 29, I think. The NASDAQ was 35, and I think the Russell was 32. My Russell target is 4,000. So that's, we're basically looking at 30 to 40% upside from here, assuming my targets don't get raised again. When I do the SMHs, the semiconductor ETF, I use that as a proxy for the semi industry. I have an 800 target on that. And when I did the numbers on that, it's about, I think, 38% from today's price. So semis are a big part of that AI thing. that tells you I still think they have at least market performance from here, maybe a little better than market performance from here. The mags, I didn't do the numbers for the mag 7, but I think you're probably looking at pretty much inline market from here, but new highs. So the one area where I have put out, it's not an official target, but the IGV, the software ETF, I said several months ago when it went through its first sell-off from its highs, I said I think it can get back to 110. And it got up to 108, a few months ago, and then sold off again, or a couple months ago. And it looks to me like, and now it's 102 or thereabouts, that 110 still looks like a right shoulder on a head and shoulder top. If that's correct, it peaked, pre-Iran, I think. I don't remember exactly, but so its top was before. It had a left shoulder on the other side of that top, and I think we're forming a right shoulder at 110. Again, it can go to 112, 114 and still be a right shoulder. I think the top was up 116 or somewhere above that. If that is truly a head and shoulder top, software may not go to new highs. And, AI is part of that. AI's, Microsoft looks pretty good right now, so maybe that's not the case. We could go on to new highs. But if that head and shoulder holds, that is one group where we may not see new highs. But I think in most of AI, I think you're going to see new highs and, another 30% plus. It's 30% plus from here, so I don't know how much above the highs that is on some of them. But Google and or Alphabet and Amazon and some of those, they still look fine. Apple looks okay despite the weakness this week. So I do think there's probably room there. On the other hand, they didn't ask this question, but when I do the numbers on my targets on things like the XLF, which is the financials, or the XLB, which is materials, you're looking at, in those cases, 50, 60% upside from here. So maybe double what you're getting out of tech now. So tech still has room to run here, but more like market performance from here or a little better. Whereas some of these things that are just coming up now that are, kind of the old economy or the more conservative stuff, some of those things are going to be the real outperformers in this final run.
I'm going to disappoint a person in the chat that said, Angelo, finally you're an hour in and asking coherent, proper questions. Thank you. Although it's a stab in the back indirectly. I'm going to disappoint you now and go on a slight rant and I think comment and try to ask a convoluted question. So you're talking about a melt up, a bust, 25% inflation looking 7 or 8 years out. We don't know what the political landscape is going to be. AOC could very well, as scary as this is, be president in 2028. We have the impact of AI that supposedly might be deflationary. In theory, it should be, David. And how about the challenge of suppose it eliminates jobs? And then you have our deficit. I'm not finished yet, going from about 40 trillion to 60 or 70 trillion. I got to be careful. This is a family show and not used. We're in a you-know-what kind of world. But this doesn't look like it's going to end so well.
I don't think so. The easiest thing to kind of look at, if this scenario plays out as anywhere close to what I'm talking about, if you get high double-digit inflation, interest rates track inflation pretty much. So you're going to have high double-digit interest rates. So keep in mind, I was a equity pension fund manager back in the early 80s when we had 18, 19% interest rates. Actually the T-bills got up to 21%, and the long bond got up to 15%. I think we're going to exceed those this time around, because if inflation goes to 25%, you're probably looking at something close to that for T-bills and high teens, if not 20% for the long bond. and for the 10-year. So as I say, and I've said this many, many times over the last several years, the equation, you can't come up with an equation that balances when you've got high double-digit inflation and high double-digit interest rates and budget deficits or a debt load that's through the roof. And as you rightly say, not everybody gets this. I talk about the worldwide debt because it's a number that I can talk about. At least it's been somebody, there's numbers out there that are this. There's supposedly 330 trillion plus in overall debt, sovereign plus private debt. That's the 330 trillion in the world. I think that could go to 500 trillion because of the bust, because what you're going to have in the bust, not only money printed, but you're going to be creating new debt to go along with that for fiscal expansion, right? Because they're going to be bailing out everything in sight to hold the system together. So you could have 500 trillion in debt. You could go from what seems ridiculous at 330 trillion. You can go up another 50 or 75% from that. And at the same time, a few years out, be looking at double-digit interest rates. We can't fund our debt. We can't service our debt at 5%. How the hell are we going to service it at 15% or potentially 20%? It won't happen. And people say, oh, they'll print their way out. That's what they just did. They printed their way out of the bust. There's a point at which, and this is, I'll have the timing wrong, I guarantee you, because it takes longer or it happens in a different timing. But at some point, and then in the next cycle, you will see the Fed will be out of the game. The printing press will be shut down because there's a point at which you cannot print more money because it instantly creates more inflation and higher rates than you just had. So it's not just diminishing returns; it's negative returns. You're every time you print more money at that point in time, when we cross over that point, you're going to be actually behind even further because that money instantly goes into even higher inflation, higher interest rates. So that at that point, the central banks are out of the game. The printing press is shut down and shut down for a long time, and all of a sudden you realize there's no there. I mean, we don't have a system. We can't go to the capital markets because the capital markets will say, you can't service it debt. We're not buying any more debt. You all of a sudden have to live within your means. And what happens, kind of like Bernie Madoff, the Ponzi scheme just unwinds very quickly. And that's by the mid 2030s. That's what I think we get is, again, this isn't just US, this is systemic worldwide collapse.
Now, David, and we have discussed this a little bit in prior interviews, if that were to play out as you describe in about 7 or 10 years, you're making it sound, as I queued up the prior question, pretty horrific. But there's a but in there. The but is it's happening around the world. America still, I think, has contract law. I was going to say the word secure borders, kind of. Oceans on both sides, the world's best farmland, tremendous oil reserves, Silicon Valley. Maybe we will be the one-eyed giant in the land of the blind. Where, if I have money and resources, not that I want to run, but where do I go? And do I just stick it out? And this is the best place to be.
I will say this, between now and that period, whether it's 2035 or 2037 or 2034, I don't know. But between now and then, there is another cycle. If we print that much money in response to the bust, the game changes. Every cycle, and I've been doing this for 53 years, we've had many economic cycles, many market cycles. Each market cycle, meaning 73 to 80, 82 to 90, 93 to 2000. Each cycle had different leadership. So obviously we know the 90s into 2000 was tech and .com. In the 70s it was oil. This cycle we're in now, it's AI, it's tech, it's semis, it's tech land mostly, but it's also other things. But the next cycle is going to be very different than this one in terms of leadership. The next cycle is going to be commodities and industrial, because we're doing a lot of capital expansion, reshoring, et cetera, and we obviously the build out of the power grid and AI. It's going to be all about commodities. I believe oil will go to $500 in the next cycle. I think it'll go to 30 in the bust, and from 30 to 500 in the following 7 or 8 years. Silver will go to 1,000, gold will go to 20,000, copper will go to who knows $20 or more from, probably more. Natural gas, which is $3 or $4, $2 or $3, could go to 50. It's going to be a commodity cycle. So as bad as it's going to be, because the broad markets, if interest rates are going from zero in the bust to potentially 20, let's say 20%, PE multiples work reverse of that. That's not a time to own growth stocks. That's not a time to own the S&P index, because multiple compression is going to be hitting you pretty hard. That's a time when you want to be in the lead stocks that can outperform inflation. And the only things that will have that kind of pricing flexibility to be able to outproduce inflation are mostly commodities, along with some industrials like Caterpillar that services commodities. But it's going to be very hard to own pharmaceutical companies or steady growers like food companies or Procter and Gamble or those, because inflation is going to be going at 20%. Those stocks are going to be going straight down. And again, not in the first year out of a bust, because the first year everything goes up. Let's say the S&P drops 80%, which is my call, is that we could see in the bear market, peak to trough decline of close to 80%. If we get that let's use 10,000 on the S&P. If we get an 80% decline, it takes you to 2,000. In the ensuing first year out of the bear market bottom, maybe even the first 18 to 24 months, you'll be in a cyclical bull market. You could quadruple out of that 2,000. You could get back to 8,000, right? That still will be far short of the 10,000 peak of this cycle. So we'll be in a secular bear market, but a cyclical bull market at that point. But you'll have lower peaks along the way over the course of the next several years. And so the only winners that will continue to make higher highs will be in the commodity sector, I believe. So energy stocks, precious metals, even agriculture probably will have a big cycle. So my point in all that to say is that you've got at least one more cycle to get your house in order, get prepared for what's coming after that, a systemic collapse. And I would take issue a little bit. I don't want to be too gloomy because I could be wrong about all of this, but I would argue that, keep in mind, we've been the winner from the Great Depression on through this, right? But we're starting to kill the golden goose. We got socialists coming in. We can talk about that later. But we got people now embracing communism in this country. And frankly, sticking to just the macro, we've spent for the last 80 years. The Fed has been the lead dog in all of this. When there's crisis in the world, who comes to the forefront and fixes things? Who leads the fix? It's the Fed. Who prints the most money? It's the Fed. The problem is, if we're going to see a systemic collapse, it may mean that the one that's been the biggest fixer is also the one that has the biggest problem when we unwind this. So I'm not so sure that we're the safe haven anymore at that point. We will be up until then. I think in the bust we will be. But in that final systemic collapse, which I call the unwind of the Ponzi scheme that's been in place for 80 years.
Okay, that you might be right. I love it. We're having a conversation where we may have some disagreements, and that's awesome, by the way. However, you got to give me within 10 years who might be that new, who's that phoenix that has potential to rise out of the ashes. And you could give me something that people may be aghast over. I don't care. Maybe it's remote like New Zealand. Maybe you think it's Russia. I have no idea. But who do you think could be several countries in play for that? Or, boy, I'm making this more complicated than it needs to be. Do we go to multiple regional hegemons and the US still has our, Monroe Doctrine here in our part of the world, but there's something different in Asia, aka China, in the Middle East, in Europe, and other parts of the world? A convoluted question yet again, but David, I kick it off to you.
I'll start it with the caveat that, chances are a lot of this stuff I'm going to be wrong on. To try to see out 5 years is tough, or even a year is tough. To try to see out through what we're describing here, what I'm describing here, is almost impossible to know exactly what comes out the other side. But my fear, I'll start with the negative. My fear is that there's a vacuum if the world collapses, if the financial system of the world collapses, and it's, it doesn't mean just the Western world. It means, China's got bigger problems than we do. They may look like they're in the driver's seat in terms of growth and things at times, but boy, they have a big problem there too. So this is going to be worldwide, and I worry coming out of this that it's going to be a vacuum that could be filled because of the agenda that's been going on for decades now of new world order, what I call code for communist takeover of the world, one world government, all of that. My fear is that they fill the vacuum with that the solution we come up with is we got to all get together and, this is going to be run out of some centralized place. That would be the worst of all worlds. The other possibility is kind of the Austrian school possibility, which is, yes, they think it happens now. I mean, they don't believe we have another cycle. I think the Austrians think, we have a reset coming in this bust. But if it's then, there is a possibility that the slate is clean, all, kind of like our hedge fund friend just had it happen. The slate's clean, everything goes down together and you start over with a hard money policy. You start over with, discipline again, and you learn from your mistakes. I think that's remotely possible. I don't think it's a likelihood. I think more likely we're going to see some sort of totalitarian type of, response. And I say it with a caveat, which is I could be all wet. It could be dead wrong. So I don't want people losing sleep over that part of this interview because it's too far out there. There's too many things between now and then that could happen differently than I expect.
Oh, David, we always seem to go down interesting roads that probably get us both in a little bit of chaos. I'm going to complicate it a little further. I'm going to challenge you a little bit on some of that. I'm extremely, as my audience will know, very, very active in AI. Maybe I'm in an echo chamber. I try to get out of it, but I'm pretty connected in Silicon Valley. I'm an investor. I use these services in a very complex and deep way every day. I look at its IQ, its intelligence. I look at the compute. I look at everything that is happening. And the last 2 or 3 months have been accelerating beyond even me, who was an optimist, what I would have thought. I look forward, forget 10 years, maybe 3 to 5 years. I'm seeing billions of AI agents transacting. I'm seeing millions of humanoid robots. I'm seeing potentially capitalism as we know it, with labor costs coming way down with robotics, to now where I'll challenge you on maybe the oil part. AI may solve for effectively, let's broadly call it fusion energy. Energy cost goes near zero. In other words, capitalism broadly as we know it will change. Everything will change. I don't know if I'm giving much of a counter to the one world government that you noted, although I presented other opportunities right before it. But I do know unless there's nuclear war and we all go in bunkers and there's 5,000 people left, AI is going to march forward and there will be changes relative to robotics, to space, which we didn't have enough time, even SpaceX, to get into, coupled with, again, energy. Maybe you may think 50 years, like I may think within 10 years, going to near zero. Where am I crazy? Where might I be right? And again, we're both taking out a crystal ball, making some guesses that are for sure going to be wrong, but maybe there's elements of what we're saying that are going to be correct.
Yeah, I think your scenario is the hopeful scenario that could cause mine to be moot. I mean, it's certainly people smarter than me, like Elon Musk, would tell you that there's a huge future ahead, and it's not anything like what I portrayed. So I'm the first one to say that's if anything's gonna be a solution to this and lead us to a place where it's far more optimistic than I portrayed, it's probably that. And I agree. I think if we have fusion, or if we have things that can really take care of the energy inflation problem, that can ameliorate things. My biggest problem, and why I stick to my guns on my scenario, and why I'm pretty gloom and doom on what happens a decade out, is because because of the bust. There's only one response that I think the easiest part of my forecast, the forecast, the shorter term forecast, the forecast of the next 5-7 years, any of it, the easiest thing, the most predictable part of it is the response to a bust. The timing of it could be a little different than I expect or what have you. But ultimately, if we get a global bust, the human response to that, whether it were Powell or whether it were Warsh or whether it were somebody else, is very predictable. They won't have a choice. There's no other solution but printing money if we get a bust. Now, and you may argue that we aren't going to get a bust. That's a different thing. But if we get a bust, I think you're going to see it's going to take a very big amount of money, and that very big amount of money with a lag will create inflation in spite of AI. Now, beyond that, so that takes care of, let's say, the next 4 or 5 years. In that 4 or 5 years, it's very possible that some of those things you mentioned can help soften the inflation, and more importantly, can kind of overcome a lot of those things and move us maybe in the next 5 years after that first 4 or 5 into something that's far different than what I portrayed. So I won't say that can't happen. I think it's low probability, only because I think we've spent 90 years in this ramping up excesses and imbalances to levels that are beyond comprehension. We talk about trillions today like we used to talk about millions. And I don't think anybody grasps the magnitude of the leverage in the system, the magnitude of the imbalances, the magnitude of the excesses. And when you get to those levels, it becomes unmanageable. It means when you make a mistake, it happens fast, and it happens in ways you just never could comprehend. And that's really what I'm talking about more than anything else in this, is that Warsh is, as I said, the most qualified Fed chairman. He has if you sat down with him and it was totally honest, it wasn't, he has to be careful saying things, but if he was able to be totally honest, he doesn't see any of what I'm describing. There's nobody in government today, or certainly nobody in policymaking places today, that has any idea of what I'm saying is coming next year. They may say recession, they may say it could be a bad recession. I don't think there's anybody in the Fed or in and Bessent's the most qualified Treasury Secretary we've ever had, smart guy, very smart guy. I don't think he if you sat down with them and you were honest. I mean, I don't think it's just protecting, can't say these things because of my position. I don't think any of them are really understanding, and I don't mean it by I'm smarter than anybody. I just don't think anybody is really prepared for this being bigger than 2008-9 by a lot. Faster, steeper. If I'm right, that means the response is going to be unbelievable and lead to those things I described. If I'm wrong, if we don't get anything close to a bust, if we have a hard landing but not a bust, and kick the can down the road, then everything I'm talking about may come way down the road, or maybe doesn't come because AI has enough time to work its magic. I fear, because of the bust being so imminent, I fear that there's not enough time for AI to really offset that.
David, and you've been very generous with your time. I could only imagine when you have me reach out to you, it's like, oh, the guy with the beard that keeps me on for 2 hours. So luckily it's only once a year. Maybe we got about 15 minutes left for about 5 questions. I wanted to do 3 to 5 on the war. We're going to have to knock it down to just 1. And then we'll really go some out of left field questions. I think the audience will enjoy it. But the war has run since February. A supreme leader killed in the opening strikes, Hormuz closed, a ceasefire signed and collapsed, and now a U.S. naval blockade. Oil spiked to 90, then sank the moment that Trump canceled strikes and said the Hormuz deal is closed. Your bus calls for oil, I think you said $30 a barrel. Does this war break your deflation thesis or actually prove it?
I think it proves it. I don't think it breaks it at all. I think if in fact the Strait of Hormuz is opening soon, if in fact this agreement is a real one this time.
Yeah, for like the 39th time, who knows?
Yeah, I wouldn't bet on it, but if it is, it'll happen soon. I mean, I think you could be, as I said, at 60, in the 60s, and maybe towards $60 in the next month, possibly even. If it's prolonged, if this is just another false alarm, and we go back to shooting, then obviously it goes back up. I don't know what the reasons for optimism are right now, but certainly there is some out there. I'd be hard pressed to understand why anybody would be optimistic about a deal given what's taken place over the last several months. I mean, I understand Trump. He doesn't, he's obviously paying attention to the midterms, but I think he's also paying attention to too many people. Like there was a time when Israel and U.S. were together and doing the bombing. I think they could have maybe actually gotten it done, but Erdogan and the Turks talked them out of it and said, no, don't go there. So they didn't do it then. And then now, one other time he was going to do something, and Saudis wouldn't let us do it because they wouldn't let us use their air base. And then just this one now, the Saudis and I guess the other, UAE, et cetera, talked them, Qatar talked them out of it and said, give us a chance to get this thing negotiated. He's number one, he doesn't want to blow up Iran because he's trying to save the economy for the people. Number two, he knows there's no public sentiment for boots on the ground and casualties. So it puts him in a rock and a hard place, and I don't know what to believe in terms of our military inventory at this point, missiles, et cetera. But he seems reluctant to go farther. I think there's certainly arguments to be made, and I think Israel would support them to say, finish them off. You're never going to get a deal with these guys. They play games, et cetera. And I tend to be sympathetic to that view, but I understand where he's at. I mean, he's trying very hard. People say he's a warmonger. He's not at all. He wants peace. I mean, he's trying very hard to do a deal. The problem is you're dealing with people that have no there's no trustworthiness whatsoever in that group.
David, boy, there could be so much I could follow up with there, but I'm actually going to punt a little bit a US term for those of you international, not knowing American football like the NFL. That doesn't mean that I want to avoid them. It just means we could do 2 or 3 hours about that. And I think there's more to cover, and other people covering the war, right or wrong, relatively good. We may debate that, but some prominent people. And I will have some guests on as we head towards the midterms where we will do deeper dives into that. My perspective, some of what David said, I would agree, and some disagree. It's complex. Let's give that one to a bit of a different time. Commodities you mentioned, and things like gold and silver. So miners, I believe you're calling for another American sports term in baseball, doubles and triples. They're levered businesses in a credit freeze. Why do they trade like almost like treasure instead of like the levered equities that they effectively really are?
Well, things have changed. I mean, when you have gold go from 2,000 to 5,500 or 5,600, and now obviously back to the low 4,000s. Silver go from single digits to 122, and now back to 60. That big rise up in the prices of the metals, even poorly managed miners figured out a way to have cash flow, and they've had probably their best cash flow in this last year. The reports you're getting there are actually really good, and they're really cheap stocks on the basis of where they are now and where they're going. My silver target is 200. And that's for this year. My gold target is, and again, I don't do calendar year. It doesn't have to be by the end of the year. I think it will be, but it doesn't have to be. Gold, my target is 7,000. And again, as I said before, I have a 20,000 target on gold for the 2033, let's say, and 1,000 target on silver. Silver. So they, this isn't the top for them. This isn't the end of secular bull market for them, but they will get hit in the bust. But I do think we just made major bottoms in both. They spent the last 6 months unwinding all that speculation that happened in January, December and January. They had such tremendous runs, particularly silver, in those couple months, and people jumped on the bandwagon very late. I've been a big bull on gold and silver going way back several years. A lot of it was ignored until this last move. And all of a sudden, again, as I mentioned earlier, the tape is what draws people into things. And they had such a tremendous bull market tape in those. You sucked a lot of weak hands people in, and you've spent the last 6 months unwinding them. And they've thrown in the towel. I think we got the bottom a couple weeks ago. And we've been kind of building this short term, trying to shake out whatever's left of people who are hanging on. And as of this week, or as of the last week, we're starting to turn the corner. And I think you're going to see. It doesn't have to happen this way, but silver could go from, silver went from, 35 to 122, and basically went from, when it broke out above 48 or 50. Went from there to 122 in a few months. You could have a steeper run this time. Even doesn't have to be, but it could be where you go from 55 was the low a couple weeks ago. You could go to that 200 and get there in 2 or 3 months. And so my view is that the miners, as a result of that big run up in the metals I see coming, will in many cases, for gold, I'll use GDX. I think GDX is where it's at now, maybe 95. I don't know. I'm calling for GDX to go to, I think 180, and GDXJ to go to 250. So those are probably 2.5 times. The silvers SILJ, which is, got down into the 23.4 area. I don't know where it is today. I'm calling for that to go to 90, so almost a quadruple. And a lot of the minor stocks, I think you're going to see that triples and quadruples. So to me, it's an area where people got pretty discouraged over the last few months because they just couldn't get out of their way. They kept going down, but that they have to look at the whole last couple of years and see where they came from. And I think we came down to a very sweet spot where they are turning the corner again as we speak.
Well, David, it is that time of the interview where now I'm going to use two more sports analogies. One, I'm not going to punt on this one, and we're coming to the home stretch. And that would be this summer, over the last 5 weeks, I did about 2.5 hours over 2 videos, me solo. I know that sounds like torture for the audience. I did them specifically among my many other solos, not only about AI, effectively on the rise of socialism and why it's, to me, horrific. And we're looking at a very different Democratic Party than the Democratic Party that we grew up with. I was even voting mainly Democratic, actually pretty much heading into the early 2000s. It's just a very, very different perspective now. The energy is all in the DSA. Socialism is in their name. They really want to have communism in the name, but maybe for now, that's just too strong a word for many. You hear them in interviews in terms of defunding the police, in terms of getting rid of DC, although that may sound a little attractive as we know it. And basically, why not give people things for free? And where is that money going to come from? What happens when you have a state, a government that effectively outcomes don't matter per se? It's their bureaucratic processing. Now, Thomas Sowell probably had the best quote on that of all time. You see a politician like Mamdani, who's a very talented politician. I'll tip my hat slightly from that showman perspective. And now that he's multiple months in and we see the rise of the DSA, I hinted earlier that I think there's absolutely a coin flip that AOC could definitely be the president in 2028. And you see younger people, I was going to say under 30, but often under 40, that is it the overproduction of elites, things I spoke about in my video, where I don't know if it's work ethic or it's timing or the type of education they got indoctrinated in a system in degrees that were not as viable to have your skill become a utility, or vice versa, your utility become a skill, your skill become a utility that you convert into making money. It's very frustrating to me. Maybe you could hear it in my voice, but my audience, for the most part, has heard my perspective on it. I would like to hear your perspective, but maybe more importantly, unlike me going on my rant, you do need to tie it into the US picture, the macro picture, investing, and your big picture about melt up and challenges. I do think it needs to tie into the money aspect. So I'm going to give the hard part to you.
So I'll start off by saying it's the same thing I've been saying about Warsh, et cetera, is I think the macro picture, because it's been building for 8 decades, and the excesses and imbalances are so great that trumps, and again, no pun intended, but that trumps the politics. And so it's almost like it's just so big, it's beyond any of that. That being said, I do worry, just like you, we're seeing a rise in who would have ever thought not very many years ago that you'd ever see anybody with a communist label be able to win primaries, let alone elections. And we're seeing that. I mean, and I put it right at the feet of the education system. You know, we've been asleep at the switch for way too long. A lot of this, by the way, and again, this is controversial, I'm sure it shouldn't be, But if you do your homework and look, a lot of this plays right into the playbook of communists in Russia or China in terms of how to take down a capitalist society. How and everything here, you go after the education system. I'm a child of the '60s. I was in college and went to college in '69, so I was right there during the whole Vietnam War protests and Kent State and all of that, and
Yeah.
the baby boomers going through the rat going through the snake, and being the kind of the thought leaders from then on. We've basically allowed and what we saw was back then, there was something called the SDS, Students for Democratic Society. It was a communist party group, and a lot of the radical students joined that. That was basically Russia or Soviet Union at that time. They were pushing that. They were involved in that on our shores, and basically what you saw was the radicals of the '60s, who were the far left at that time. Um, they they made a concerted effort to go into the ministry, teaching, colleges, and with the idea that we want to be able to mold minds. And where do you mold minds best? Where you have captive audiences, particularly young captive audiences, which is the public schools, the colleges, and churches. And what you see today is mainstream Protestant churches. It's happening in the Catholic Church too, but mainstream Protestant churches are far left. You know, they their platform or what they preach is almost coming right out of the Democratic platform. I mean, it's their issues and their interests align very much with that, and they're now in the last 5 to 10 years, they've become very outspoken about um, preaching against conservatives, preaching against even conservative churches, even Protestant churches, and because they don't agree on the kind of the political stuff. I'm going there somewhere with this, but it's the same thing with the education system. So what we've got now is a whole generation of kids who are at voting age now, and from 20 to 50, who have been brainwashed and fed this propaganda all the way through their years. And some are able to kind of think their way out of it and think for themselves, but a very large number are now in that place where they actually believe maybe communism isn't so bad. Maybe the problem is capitalism. Maybe we should do away with the electoral college system because um, it um, it favors those that are. Angela, I think I've lost you.
Welcome, everyone. If you are staying with us almost 2 hours into my interview with David Hunter, in my little rural community, unfortunately, we lost power. Now, we were heading to the home stretch. I think David is back now. Let's see if we could. David, or could you hear me?
I hear you. I see you.
I can't hear you.
Oh, let me see.
Okay, yep, you're good. You're good.
Okay.
Okay. David actually knows a little community where I live in. It's a little tiny little rural-esque type town. We do lose power, multiple acres, trees falling down, a whole bunch of reasons. So sadly, for about 2 or 3 minutes, we lost power. We are probably down to our last couple of minutes. David, just so it doesn't happen again, and maybe there's forces at work that made it happen when you were such in an important part about maybe putting a little bit of bow on the topic that we were talking about. And then we'll close with a little bit of me challenging you a little bit and a little bit of a family office question. So if you don't mind, if you could wrap up on that last question in a minute to 90 seconds, we'll move on to the two final.
Yeah, very quickly. I mean, I was kind of rambling, but I do think that we people need to be very aware that our country is radically changing because the younger people do not really understand economics or capitalism and have been taught pretty leftist philosophy and have just don't know any better. And they are today's voters. And I think we should not take lightly the fact that we are seeing the so-called Democrat socialists gaining ground. And I do agree with Angelo that we could see somebody like AOC, as crazy as it sounds, that she could actually win an election given where we're at. I still am hopeful that we're not at that point yet, but we're moving very fast in that direction. And I think there are a lot of signals out there that we should not be ignoring. And it's problematic.
David, it's with all due respect on my question, and this goes back to some degree to others that I've asked earlier. You have 53 years of work, and I'm being a little bit dramatic, but coming down a little bit to one call. And if you're right, well, you're the man who saw like the biggest crash, since the late 20s coming. And if you're wrong, like it's the first line in my words, an obituary relative to a career. Am I being a little dramatic? Sure. So you're sticking to your guns. You might be right. Timelines, well, they do adapt somewhat, but you haven't backed down. Tell us a little bit in terms of your perspective, how I phrased it, why you feel this way, and it's important for you to get this message out. You don't have a fund. You don't have a truly significant financial stake in it. Yes, I'm assuming you have some subscriptions and things like that, but relatively, you're not doing this from your own monetary perspective. You really believe it. Why? And is there anything that could change your mind?
Yeah, first, I'm retired, so I'm 74 years old, so I'm not worried about a legacy or none of what I'm putting out there is anything but what my analysis suggests should happen. That's one of the reasons I've got 400,000 followers, I believe, is because people know that I just speak what I see. None of this is gamesmanship or trying to be remembered for something. It's none of that. And frankly, I've in my career as a money manager, et cetera, I made big calls in 82 and in 93 and in 2000. This one obviously is a game changer. 2008, in September 2008, I was one of the very few out there talking about a hard landing. And almost every economist and strategist out there was saying soft landing, no recession sight. We were weeks away from the biggest financial crisis since the Great Depression. So that shows you how this stuff can unwind fast and happen fast. Um, but basically, I'm looking at my analysis and I'm putting out what I see. Can I be wrong? I sure can be. Am I worried about the fact that this might not happen the way I say it? Well, obviously, I don't want to hurt people, and I don't want people. Um, I'm not putting out anything that I don't believe, but people have to understand these are forecasts. It is the future, and things don't always, and it is an extreme forecast. So it may or may not play out exactly that way. As if my analysis suggests otherwise, I will change as we get there, and I think I'll be able to change it ahead of time for that. But just like I have adjusted on the bull market that I thought could have ended a couple of years ago and stretched it out. Again, it's not a game. It's what my analysis says. If my analysis says this thing continues, I'll be continuing. But as I see it right now, we're coming to an end of a major secular bull market that's longest in my lifetime and your lifetime by far. And what follows that, I think, is going to be very unpleasant, but we'll see.
David, at the heart, my audience is the single family office. I've been in that business for multiple decades. I dedicated my life to it. And areas around family office structuring, geopolitical, macroeconomics, investing, and lately AI from a multi geopolitical investing, but a deeper operational perspective. Not your concern at the moment, but you being a macro person and an investing person. Now, again, they may have 100 million, a billion, they may have hundreds of billions. So dealing with tough times over multiple years may be something that they have the strength to pull through. Now we could get into a deeper discussion on be careful with a major bifurcation of haves and have-nots. Remember the French and Russian Revolution. Both you and I are relatively fluid in history and philosophy. You hinted at some things earlier, which I didn't even jump onto with Mao and things like that. Like, look at how many tens of millions of people died because of communism with Mao. But go back and listen to my two solos where I talk a little bit more about that. What would be a message specific, I know, to a very small subset of people, the single family office principal, rising gen executive, relative to what you're describing, whether it's a macro take, a commodities take, an investment take? What would you have them like to walk away with?
Yeah, probably right now, because of where we're at in this cycle, this is a message I give to in many of my interviews. But basically, understand how far we've come. Know yourselves as money managers, and basically, my forecast doesn't say stay right to the top because I know where it's going and get out. But what I have said is we've spent since the mid 80s, the financial industry has pushed this mantra of it's time in the market, not timing the market. If I'm right, and I'm at least on parts of this, I have lots of conviction. We are at a point where rules are made to be broken, cliches are made to be proven wrong. There is a time when, and those who followed that mantra of time in the market, meaning just keep dollar cost averaging or keep putting your money in the market because it always goes to new highs. We may be at the end of that, where timing the market is going to be the biggest story going forward, at least right now, where sometime in the next several months, if you stay with the mantra of it's time in the market, I'm not smart enough to time the market, so I'm just going to stay fully invested and ride it through because next cycle will be higher. As I said, this secular top may not be revisited for decades. And so it really does behoove people, particularly professionals managing other people's money, family offices managing their own money. It behooves people to understand that if we're looking at anything close to an 80% bear market, the way the math works, you can have a great cyclical bull market coming out the other side for a year or two and get half your money back or 2/3 of your money back, but I doubt you're going to get all of it back unless you obviously you can change horses and do it maybe in commodities. But I think this is one of those rare times where, particularly in the last 40 years, where it does make sense to say, I'm going to cash, or I'm going to treasuries, or I'm going to something that doesn't have the volatility. Not necessarily today, because I still think there's 30, 40% upside. But in this period, take advantage of that strength and understand that capital preservation is going to be your number one goal for the next year. And then on the other side of that, there'll be great opportunities in different leadership. But then you're set up in big ways. If you just ride this through and say, well, I learned through 40 years of lessons that we always come back and you should not bet against the U.S., this is one time where that may not work out for you.
Well, that's a little bit of a harrowing way to end, but we do have to bid a fond adieu. David, for those that would like to learn more about you, if they don't already follow you on X or any other way to learn more, how could they do so?
Sure, I'm on X every day pretty much. I respond to questions and comments. I don't do a lot of original posts, so you have to have your settings set up to see replies. I just found if I did original posts, I got so many replies, I got so many comments and things I couldn't keep up, and I really do try to respond to people. So that's how I communicate mostly, is through replies. You may see 30 or 40 replies in a day on given days, and others maybe, a dozen or two, but I'm there pretty much every day, and my views are, what they are. They're contrary typically, and I'm not afraid to speak my mind.
That is for sure.
But that's where I'm at every day. I kind of, when I retired, as I said, I decided this was one place where I could kind of keep my hand in it and help people. And then I also do a quarterly letter that is by subscription, so there's a fee to it. I had a money manager who gets it, subscribes to it, who nicely probably a month ago, put out a comment saying, this is such a wonderful letter. It provides so much insight, and it's almost free. And all of a sudden, I got all these people asking for it. But when retail people hear almost free, they think it's almost free. In his mind, it was almost free. In their mind, it wasn't necessarily that. So there is a cost to it. It's not exorbitant, but it's, it depends. If you're a little guy, you may not find it almost free.
David, I enjoy your work so much, your commentary, your contrarian views. It's great to have some disagreement that makes it a engaging conversation, myself included. We all got to be careful about getting out of echo chambers. As new information comes in, we do need to change our mind. And yes, some of that plays into some of my political and geopolitical comments as well, and mistakes and echo chambers that I get into like anyone else. I'll keep my close relatively by my standards, pretty simple and straightforward. One, thank you to David Hunter, our live audience, those who will listen and watch this. I hope you enjoy it. It's the summer, but it's a good time to spark interesting conversation. And again, the 2 hours flew by easily. We could have done so much more deeper dives, including with the war, more global perspectives in Europe, and even a deeper dive on some of the political issues that we went to and why it's important from a macro investing and effectively a societal perspective. But at the end of the day, especially in more short form content than ever before, 2-hour interviews, well, they are a little bit long. Everyone, I'm Angelo Robles. You could follow me primarily on YouTube, on LinkedIn, also on X. David is about 1 million times bigger than me. He's the star. I just like to do hopefully good interviews and get some unique information out. To find out more of what I do full-time over multiple decades in the family office world, I'm the original founder of Family Office Association. I sold it, retired, invested. I reopened another private community dedicated to incredible entrepreneurs, families, and family offices that they get my proprietary content, my 4 days in Palm Beach, my multiple roundtables in Europe, America, LATAM, and around the world. And lately, a lot of people know my proprietary books and my multiple multi-day immersive masterclasses on AI for family offices and ultra high net worth investors. Learn more at angelorobles.com. Simple. Again, David, thank you again. Appreciate everyone. Have a great summer, David. I appreciate your time.
Yeah, thanks, Angelo. As always, a lot of fun.
Appreciate you. Thank you so much. Thank you.